Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and today we're going to discuss earnings season. We've just been through full-year results. Well, they'll finish tomorrow, and it's been okay. Been some beats, been a lot of misses, and a lot of movement in share prices, which has shocked everyone. And to discuss the earnings seasons, I have Charlie Aitken from AIM Funds and Ben McGarry from Totus. Welcome, gentlemen. Ben, I'll start with you. Any kind of macro themes that came out? Certain sectors doing well, certain sectors underperforming?
I could think of one theme that was interesting this reporting season. It was the increased use of aggressive accounting to hit market numbers or maintain growth rates. Companies are using things like excessive capitalisation of software investment, running it through the balance sheet rather than the profit and loss. Using things like acquisition accounting to release provisions to boost profits, even things like factoring payables. So all of that tells us that these companies are having to run faster to meet market expectations. So
not a good sign. And I can't remember the last time a company said, well, our net profit was. Yeah.
Exactly.
You know, it's always underlying or it's EBITDA. Charlie, something you found that
I'd agree with Ben on that.
A bit more inspiring than what Ben had to tell us?
A lot of abnormals and things like that. No, I thought it was a pretty ho-hum reporting season. I think that cost escalation in resources was something that I thought was interesting. I thought that the margins have peaked probably in the resource sector.
Right.
I think that companies have really been not spending enough on capex in the resource sector. So I think perhaps the margins have peaked in resources, cash flow may have peaked in resources. I thought that was interesting. Most of those stocks are very well held now, and they didn't really beat expectations. I thought that was interesting. But look, really, for me, the price movement for small changes in consensus earnings was unbelievable. I've never seen anything like that, and I think the price reaction, both up and down to results, was probably more stunning than the actual results.
Well, it's quite interesting, isn't it? You know, some companies that just met what everyone expected, up 20, 30%. Some days you wanted Valium, some days you wanted uppers. Is the market changing, and is the volatility around earnings season?
Well, there's something changing. I mean, if you'd basically been short the most well-held stocks and long the biggest shorts, you would have had a fantastic reporting season. So for me, it was a lot more about positioning. I suppose that's what you learn, than necessarily the results, expectation and positioning. But it's new to Australia. I think some of this price action reminds me of what happens in America on a quarterly basis.
A lot of second and third derivative type investors.
Yeah, but then also some of those moves can fade within a day or two. So we've even seen stocks, open down 6%, finish up 8% on the day, 15% intraday movements, which to me is a lot of money, a lot of fast money playing in a small space. And I think that's what's changed.
Yeah, maybe we've just got to sit through the turbulence early on. But okay, let's go forward. Let's get through the turbulence and let's think, well, what has the reporting season told you about how you're positioning your portfolio on the long and the short side? Has it changed or is it the same?
Yeah, one of the key things for us was that we were pretty cautious heading into reporting season, particularly around stocks exposed to a housing slowdown. We may have been a bit early there. I think the results that were reported generally weren't as bad as feared. I think it's potentially the next 6 months that is the issue, with bank funding costs going up, credit growth slowing, the gradual increase in investment from overseas players like Amazon and Aldi. So we were probably a little early there, and things weren't quite as bad as we had thought it may be this reporting.
And what about those mid caps with big multiples that everyone talked about for a long time? They came off, but lo and behold, guess what? The multiples are getting bigger. Yeah. So what do you do with those stocks? Valuations crawling it.
I think exactly what Charlie said. They're extreme moves in the short term, driven by positioning. I think we've got a lot of long-short money. Large funds are getting bigger, particularly growth funds. A lot of funds like L1, VGI have raised a lot of money. So there's big funds meeting in crowded places in thinly traded stocks, and the results can be spectacular in the short term. But I think that provides an opportunity over the next couple of months as eventually sanity prevails and earnings and cash flow become the gravitational pull for share prices.
Okay, Charlie, let's get to your portfolio. You just told us resources may have peaked. Yeah. Costs rising, not spectacular compared to expectations on the earnings. Do you start shifting your portfolio around? Does it go back to the other part of the barbell where banks are on the knees? Where are you at?
No, banks absolutely no interest to me. I think I agree with Ben. I think that the reporting season confirmed the last 6 months' earnings. The next 6 months' earnings could be quite different. I think we can absolutely see there's a housing slowdown starting. The cost of money is going up. The availability of credit is going down. All the factors that drive lower house prices, lower consumption are starting to hit Australia. You've also got political uncertainty, which came after the reporting season and into the new financial year. So look, For me, you know, I think some of the multiples on some of these sort of fintech type, you know, exposures in Australia are ludicrous. Absolutely ludicrous. I think the market's got a short memory. And I think a lot of the short money in Australia is not sticky short money. People say they're structural shorters, but the shorts in Australia are very weak-handed. Present company excluded.
Yes,
Present company excluded. But it seems that we don't have the tolerance for pain in shorting that the rest of the world does. And I agree with Ben. I think there's some situations in Australia that you might have been wrong on the 6 months that were just reported, but in 12 months from now, you might be very right.
Okay, let's keep going on down the bad part, Ben. Going back to your first statement about what earnings look like and, you know, pieces move, the deck chairs moving around the Titanic. Is that got you worried about anything in particular? Have you found some stocks that you think, well, in the long run, I'm going to be right on this because they haven't fessed up their real earnings?
Yeah, look,
just opportunistic for you.
Well, back on a couple of those most really expensive stocks. I mean, stocks like Domino's and WiseTech missed earnings on almost every metric you can think of, and rallied hard. We think you know that's got to be short term, and that there's eventually some catch up that'll come in those share prices. They're the ones that were really surprising when we think the opportunity is over the next few months.
So it might have been a bit of a ho-hum season, but as usual, investors found a way to thrill themselves.